The economy has come to a halt. And any idea that GDP is rising, I mean, it's only rising on the excess spending that the government is doing. That's not productive spending at all. The technical position in the market now looks very, very good because having just backed off from that 2000 level for what? I don't know, fourth, fifth, sixth time, I think it's ready to really go through. It's all credit. If you want to protect yourself from a collapsing credit system, and the reason it's collapsing is because it's dollars that run it, and it's dollars that are collapsing, and that will take down everything else. If you really think that is a risk, then you have to get into money, which has no counterparty risk at all, and that is only one thing, and that is physical gold.
The U.S. economy is precariously balanced on the brink of a substantial debt spiral, poised to send gold prices soaring in the upcoming quarters. Recent inflation data, revealing an unexpected cooling of consumer prices in October, has reshaped expectations concerning a potential December Fed rate hike. Consequently, the gold market experienced a surge, nearing its session highs and indicating possible breakthroughs. Alasdair McLeod, the head of research at GoldMoney, underscores the significance of the repeated approach and retreat from the $2,000 level in the gold market, suggesting a promising breakthrough that could lead to substantial gains and a positive shift in the market's dynamics. The ongoing ascent in gold prices, marking the first weekly gain in 3 weeks, mirrors investor confidence in the Federal Reserve's decision to halt interest rate hikes, placing pressure on the dollar and Treasury yields. Furthermore, the dollar experienced a decline of more than 1% against major currencies on Tuesday following U.S. consumer price data that indicated a further moderation in inflation in October. This has increased the likelihood that the Federal Reserve has concluded its interest rate hikes. John Doyle, the head of trading and dealing at Monex USA in Washington, anticipates a continued weakening of the dollar towards the end of the year, possibly extending into early January. Alasdair McLeod foresees that the decline of the dollar has the potential to set off a domino effect, adversely impacting various aspects of the economy. He strongly advocates a shift towards investments without counterparty risks as a protective measure against the looming collapse of the credit system. However, Alasdair's primary concern is rooted in the fundamental economic landscape, particularly within the United States. He emphasizes a growing budget deficit and asserts that government accounting manipulates deficit figures, concealing the true financial state. With the expectation of higher debt interest payments due to rising rates, Alasdair predicts an impending recession. Clips from Alasdair McLeod's interview with Liberty and Finance will be presented shortly. If you're interested in more videos like this, please consider subscribing and turning on the notification bell for future updates. Thank you.
For the last 20 years, everybody's been telling us when interest rates rise, that's bad for gold. When interest rates fall, it's good for gold. But gold fell with interest rates, with bond yields, if you like. But then there came a point where, we bounced. So it just shows how the technical moves you're seeing in the market actually got nothing to do with, what we're being told by so-called experts in the market and all the rest of it. And I think that the technical position in the market now looks very, very good because having just backed off from that 2000 level for what? I don't know, fourth, fifth, sixth time, I think it's ready to really go through. And if you look at the moving averages in the chart underneath it, they are moving up in bullish sequence. They underwrite the price around about 1920, 1910, something like that. We didn't actually get down to there. I think we got down to, 1930 or something. So you can see that a number of things are coming right. Now, we need to look, I think, at the fundamentals as well. And that is, if you just look at the situation with the debt trap, that there is absolutely no doubt America cannot escape. And America is important because the dollar is the currency which every other currency is tied to. They refer to the dollar. If you weaken against the dollar, you have to raise your interest rates. And if you want proof of that, just look what happened to the yen. I mean, they've still got negative rates in Japan. They're desperately trying to suppress bond yields. And the yen has collapsed. It's gone from, 110 down to 151, something like that. I mean, this is something like a 40% collapse in not a lot of time. Why? Because they have resisted the rise in interest rates. So everybody else has to raise their interest rates in order to keep up with the dollar. And this is creating a real crisis. But the problem that we have with the dollar is who is going to buy all the government debt that is due to be rolled over and new debt issued in the current fiscal year, which only started at the beginning of last month. We're looking at 7.6 trillion of debt being rolled over. We're looking at, well, I think that the budget deficit this year could well be well in excess of 3.5 trillion. What makes me say that? Well, first of all, last year it was nearly $1 trillion of interest was in that debt. They also fiddled the figures. The figures came out at about 1.7 trillion deficit, but actually that included an adding back of $300 billion, which they had originally allocated for paying off students' loans, but then the courts turned that down. So what do? It was never drawn down. They just add it back into the figures. So they reduced the level from 2 trillion down to 1.7. I mean, this is the magic of government accounting. So actually, the deficit was 2 trillion, of which 48% was debt interest. So what's the debt interest going to be this time round? Well, we can see this 7.6 trillion is going to be refinanced at higher rates. You have got whatever the budget deficit works out at. So you're looking at something like up to 11 trillion has got to be financed at current rates. Compare that with what the average debt interest was in the last fiscal year, and you were looking at 2.7%. Now we have short-term rates over 5%, and the yield curve's a bit negative. So, but you're still paying 4.5% going out along the yield curve. There's no way that you were going to see debt interest, I think, much below 1.5 trillion. So 1.5 trillion of debt interest. And if, we're heading into a recession. Of that, I'm absolutely certain.
The failures of a group of mid-sized U.S. banks earlier this year garnered significant attention, raising questions about the efficacy of their risk management programs. In a recent report on the 2023 banking turmoil, the Basel Committee for Banking Supervision characterized these bank failures as the most substantial system-wide banking stress since the Great Financial Crisis, GFC, both in terms of scale and scope. Alasdair McLeod strongly asserts that the Federal Reserve and the U.S. Treasury play pivotal roles in ensuring the stability and resilience of the banking system. Their decision not to pursue a bail-in strategy aligns with the imperative to safeguard depositors, a move motivated by concerns over the FDIC's potential lack of adequate resources to effectively serve as a safety net. According to McLeod, there is an urgent need for a discreetly handled rescue plan to address the crisis within the system. He highlights the Federal Reserve's proactive measures to support banks, particularly their acceptance of undervalued bonds as collateral for loans at their full face value. This strategic move aims to prevent crises akin to those witnessed in Silicon Valley banks, which suffered from mismatches in funding long-term debts at lower rates and incurred losses when interest rates surged. Let's now return to the interview.
I think the first thing, your point about Dodd-Frank and bailing in and all the rest of it, I think is well made. You have to bear in mind that probably the most important function of the Fed and the US Treasury is to ensure the integrity of the commercial banking system. They will not go down the bail-in route. They have to protect depositors because the FDIC is not large enough, actually, to act as a backstop. And in any event, this idea that rich depositors, well, who cares about them? I mean, that's nonsense, because that's not how deposits originate. Deposits originate with loans. And, the deposits, if you like, are the symptom of the loans on the other side of the balance sheet. Really, it means there has to be a rescue. We don't know how much the rescue is. We can't quantify it. All we do know is that the whole system is in crisis, which is being sat on. I mean, this is the whole concept. But this is why the Fed has gone into the market and into the banking system and said, look, if you've got bonds which you want, which are underwater, and your auditors are saying you've got to value these at mark to market, We will take those on our own balance sheet and lend you 100 cents on the dollar or $100. We will lend you the face value of those bonds, so that you can say to your auditors, you value these at par. And also, of course, the Fed is valuing their holdings at par. So the reason they've had to do this is basically to stop the sort of Silicon Valley Bank crisis, where banks bought long-term debt, funding it, at sort of the Fed, close to the Fed funds rate of at the time of sort of just over zero, getting a yield pickup of say 0.75% on a 10-year US Treasury, and then finding that their P&L account has got destroyed by the rise in interest rates because they're having to fund it now at 5%, 5.3%, whatever, and at the same time the capital value of the bond has collapsed. This is, and it just completely destroys any bank with any degree of operational leverage. And that's what's happened. I would expect, more or an extension of that, and also more help from the authorities. Now, whether it's the fiscal authorities, whether it's the monetary authorities, they will sort it out between them to try and stop the rot. So what actually is that rot? Well, we do know that banks have got real trouble in terms of bonds with long maturities, or certainly longer than short-term maturities, more than 1 year, on which they've got capital losses. We also know that these banks are facing problems from their loans. Look at commercial real estate, for example. I would say also the private equity industry is also getting into great difficulties because they've basically leveraged up equity investment on the back of low interest rates. And as those low interest rates have to be rolled, they're facing, it's just made the whole thing completely uneconomic. We've got that problem in this country. And I don't know to what extent it's a problem in America, but I can imagine that the problem is there as well, because the private equity industry is a very, very big industry.
Gold is currently achieving new highs and showing signs of potentially forming a bullish flag pattern. Notably, even Richard Kiyosaki, the author of Rich Dad, Poor Dad, predicts a gold price of $5,000 in the next few years. Many banks also indicate that gold has substantial potential over the next 5 years. As we consider recent market trends and economic indicators, it becomes essential to assess how they might influence the trajectory of gold prices in the near future. Observations and insights on this topic are encouraged in the comment section below. If you found this video informative, please show your support by liking it, subscribing to the channel, and turning on post notifications for future updates. Thank you for watching, or